You have questions. I sometimes have answers. I'm ready. Demi's ready. Here we go. Oh, and a huge thank you if you liked and subscribed this channel. I couldn't do this without you, and I hope this adds value to your life. Are you ready? Let's jump in. Why savers are losers. Now, I don't mean losers in like the loser sense. I mean losers more like you're losing money by saving. And I'm gonna show you why in this interest rate economy, saving money might actually be causing you to lose money. You've probably heard the old adages, a penny saved is a penny earned, patience is a virtue, the grass is always greener on the other side, the sun's still shining, another day, another dollar. It's a dog-eat-dog world out there. I'm hearing my father's voice echo in my ears as I'm doing this. What? So reason number one as to why stashing your money in your mattress might actually be losing you money in the long term. Inflation. Number one is inflation. We have to talk about inflation. Inflation is the silent killer of your money's purchasing power. The definition of inflation is a general increase in prices and a fall in the purchasing value of your money. For example, in 1987, a gallon of gas was like 50 cents. I remember the days when I could almost fill up my tank with like 20 bucks. But in 2021, that same gallon of gas is like $3. Let's take another example. If you went to the grocery store in like 1990 and bought a gallon of milk, that gallon of milk would cost you $2.78. In 2021, that same gallon of milk would be $4.15. That's called inflation. These are perfect examples of the purchasing power of your money over time decreasing. How do you measure the effects of inflation on your savings? I'm glad you asked. How do you measure the effects of inflation on your savings? The most popular way to measure inflation is with a CPI graph. Now, a CPI graph is basically an index that tracks what happens over the long term to your purchasing power of money versus the cost of certain expenses that rise and fall depending on the economy and the interest rates. It's just a complicated way of mapping and measuring what happens to inflation. But here's another example to keep with our savings theme. Let's say you kept your money in a savings account that earned you 1% per year in interest annually, and the CPI that year went up 2%. You actually lost 1% to inflation because your money was just sitting earning 1%. So you are a saver, but at the same time, you're actually a loser. Now, I want to talk for a minute about inflation in the United States. Believe it or not, inflation can be too low. In the wake of 2008, central banks in the United States, Japan, and Europe were worried that inflation could go below zero, meaning deflation or falling prices. The United States did experience deflation in housing prices lasting several years in many markets. During the worst of the crisis, the Federal Reserve targeted a 2% annual growth in inflation to return the economy to health. The bank initiated various stimulus measures that were intended to boost the economy and encourage job creation, therefore putting more money in the customer's hands. Now, just to be clear, I don't expect catastrophic inflation anytime soon, but in the face of uncertain times, it really doesn't hurt to bolster your finances. Here's a couple of things that I'm doing to help support my finances, and I think some of these may be helpful for you too. Number one, the biggest thing that I'm doing right now is I'm continuing to invest in the stock market. Equities over the long term have been the best hedge against inflation. We're going to talk a little bit more about real estate and housing as it pertains to inflation, but for right now, I'm still investing in equities. This dynamic of investing in stocks holds over the long period of time. However, this can fall apart in the short term if there's spikes in inflation. Rapid inflation is really tough on businesses. If you're a small business owner, you know what I'm talking about. Small businesses absorb higher prices, and it takes much more cash to maintain the same level of productivity on a day-to-day, week-to-week basis. Number two, the second thing I'm doing is I'm rethinking my emergency fund. Now, don't get me wrong, I'm not throwing the emergency fund out the window altogether in hopes that all of my money would be in equities, hoping to outpace inflation. I'm rethinking it. Track with me for a minute. It's hard to hold a stash of cash in a savings account when the value of that cash is rapidly falling. For that reason, many experts will tell you to dump your cash when inflation is on the rise. I'm actually taking the opposite approach and adding to my emergency fund. Here's why. Right now, my emergency fund is pretty lean because I can borrow money cheaply. Inflation blows up that plan in two ways. One, If prices are rising, my lien balance will definitely be insufficient to cover living expenses after an income loss, God forbid. And 2, rising interest rates would take away the option for cheap debt. So for these reasons, I'm actually continuing to add cash to my savings account. I've maintained a 6 to 12 month emergency fund based on our expenses just for peace of mind. Now I know this 6 to 12 month marker might seem high to some, but I'm actually on the opposite end of the spectrum. Keep in mind, a higher allocation in cash for me allows me to be much more aggressive with equities, meaning I'm not holding any bonds currently in my portfolio. This serves 2 purposes. Number 1, I have plenty of runway to land on if there's a sudden loss in income should I lose my job for any reason. That's still 6 to 12 months of expenses saved up. I could basically take off for a year and decide what I wanted to do. And number 2, if there is a large correction or downturn in the market, this allows me to capitalize on the opportunity to invest more at a discount. Good girl. Number 3, acquire real assets. Now let's talk about real estate for a minute, because real estate can be a great hedge against inflation if used properly. It is possible to protect your savings against inflation by investing in Treasury inflation protected securities or TIPS, government bonds, stocks, or precious metals like gold, silver, or other commodities. Real estate can be one way to hedge your bets against inflation if used properly. Number 1, buy rental property. People always need a roof over their heads, so they pay the going rate for housing. Whatever it is in today's economy, rental properties offer an ongoing advantage like passive income, tax advantages, and the ability to leverage other people's money. In fact, in recent economic studies, rent actually is one of the most consistent indicators or significant drivers of inflation. This makes rental properties a prime asset class to combat inflation. Number 2, real estate investment trusts, or REITs, R-E-I-T. REITs are an investment fund that invests either directly or indirectly in real estate. Despite being a paper asset, real property securities, REITs, and their returns tie directly to real estate values and rents. That affords them similar inflation protection to direct real estate ownership with far better liquidity actually. Number 4, you can invest in commodities like gold, silver, or other precious metals. Commodities are physical items with inherent value. They range from metals like copper to energy like crude oil and natural gases from lumber to food like grain, sugar, and coffee. While technically precious metals like gold fall under the category of commodities, they hold a special place in the world of inflation protection. While I don't own any of these directly, investing in the total stock market index fund can cover you by buying into a small piece of the total stock market, including companies that manufacture different commodities. And finally, as effective as many investments are during times of inflation or deflation, don't forget about the most crucial aspect of all. Invest in yourself. Investing in yourself can give you one of the best returns for your money you can possibly get. I've developed a really bad habit of just buying books about topics or things that I want to learn about, investing strategies, personal finance. I just love investing in myself in that area. Your continued ability to earn money and grow your company and bring value to the workplace is your greatest asset. It really is your greatest asset. Now, if you made it to this part of the video, you're probably already a person who values investing in yourself. So give yourself a pat on the back. The fact is that if you can position yourself well in good times, it'll be that much easier to weather the storm through bad times. Do me a favor and send this video to one of your friends who is stuffing money under their mattress thinking that they're doing the right thing. It might actually help them out. Well, thanks for watching to the end of this video. Remember, if your money could talk, it would say, I'm a means and not an end. I'm a tool and a test. I can bring meaning to life, but I'm not the meaning of life.